My name is Michael Duke, and I like stocks. I like to analyze them. I like to watch the market. I've been investing in stocks for the better part of the last decade. I also have experience in private real estate, both through my own investments and working acquisitions at a private equity real estate investment firm. If you are interested in like content, analyzing the stock market, investing, dividends, so on and so forth, then be sure to like this video rather and subscribe to my channel because I do this all the time. It's practically my obsession. So anyways, today I'm going to be talking about Otis Worldwide Corporation, ticker OTIS. And this is an interesting company. Just some background on Otis. Otis is a manufacturer, installer, and servicer of elevators and escalators worldwide. There's two segments: new equipment or construction and service. They're headquartered in Connecticut, but they've been around for a long, long time. In fact, they were founded in 1853. So just some history on the company. The genesis of it was around the namesake of the company, Eliza, I don't know how to pronounce that. Mr. Otis, we'll call him, who invented a safety device in 1853 that prevents elevators from falling if the hoisting cable fails. So he was responsible for a revolutionary new technology that changed the elevator industry. In fact, it was prior to that, the elevator industry was somewhat of an upshot. Elevators were new, they were unreliable. People were afraid to ride in elevators. But after a demonstration of the technology at the 1853 World's Fair, the elevator industry established credibility. So pretty cool. This company's been around for a long time, but if you noticed at the beginning of the video, it only has trading history going back to March 16th, 2020. So why is that? Well, because it was acquired, it was a private company, it was acquired by United Technologies Corporation, which merged in April 2020 with Raytheon to form Raytheon Technologies, or RTX. So it was spun out of United Technologies, which traded as UTX. It was spun out of this company because it didn't really fit with the RTX portfolio of companies. So since the depths of COVID, it has been a publicly traded standalone company. Just give you an idea of the elevator market. Otis is the largest company in elevator and escalator manufacturing, installation, and service. And they have 2.3 million units worldwide, or 2.3 million elevators and escalators that they service. I believe that they've built more than that. They actually installed the elevator system that is in the Eiffel Tower in 1889. So this company, it benefits from very, very strong market share, very, very strong presence in the market that it operates. Otis, Schindler, TK Elevator, and Cone are the top four manufacturers, collectively holding 67% market share. According to the summary here of the Google generative AI, Otis Worldwide Corporation has an estimated 18% global market share for elevators and escalator. Otis is the world's largest manufacturer of elevators and escalators by revenue. So, in other words, Otis is the market leader in elevators and escalators. If you've been watching my videos for a little bit, I just started posting on YouTube, but I like to talk about the company overview. I like to talk about if the company has a moat, and I like to discuss the thesis around why it's an interesting company and really how it makes money. So this company is very simple. Between the two segments, you have the new equipment and the service segment. Um, Otis benefits from new construction. If construction activity is going up, conceivably Otis is experiencing a boom in its new equipment revenues. Now, let's just imagine for a second that you're a real estate developer that is installing and needs to install an elevator system. You're going to hire, you're going to likely reach out and get bids from one of these four companies. Otis has the biggest presence. Maybe their bid's the most compelling. You decide to go with them. And if you were to install an elevator, you would likely be compelled to hire that company to perform the service. You have to have your elevators and escalators serviced on a regular basis. Obviously, that you can't skimp money on that. You have to do it. There's life safety concerns if you don't take care of your elevators and escalators. The service component of the Otis business and any escalator and elevator business is sticky. It's recession resistant, and it's recurring and non-cyclical. So a company like this will benefit from the cyclicality of construction and economic activity, but they then more often than not will lock in a service contract with the customer that they installed for, and they will lock in a long-term relationship that provides recurring revenues that are very high margin. In fact, if we look at their report, so this is their most recent earnings report, we see here that service makes up the bulk of their net sales or revenues versus new equipment or new construction. That represents roughly 2/3 of their revenue, but it's even more pronounced in their operating profit results, showing that 80 to 90% of their operating profits are driven to the degree of a significant extent service versus new equipment. So what does that imply? It implies that the margin on the service business is much stronger than the new equipment business, which makes sense. If they have to install new equipment, they have to compete with the other vendors, whereas locking into a service contract, it's a lot more likely that the person, if they win a bid for new equipment, they win a bid for service. And that service contract they will be able to maintain for a long, long time, perhaps decades. So super interesting, right? Does this company have a moat? Well, yes, of course, driven by the service element, and furthermore driven by the fact that what they build is critical infrastructure that becomes a piece of that real estate asset, and it must be maintained. So their moat comes from the fact that what they build is tangible, and it needs to be in operation for a long time, and it needs to be safe, and that's what drives their moat. They have sticky, recurring, high margin revenues that are driving the majority of their economic profits. In fact, if we look at their annual report, and we'll come back to this later, we see here service comprises approximately 60%. This is the 2023 annual report, by the way. Service comprises approximately 60% of our net sales, approximately 85% of our adjusted operating profit. That's pretty compelling, right? So Morningstar agrees with my assessment of the moat. They have a wide economic moat, allowing them significant pricing power and sticky, dependable cash flows over time. The cyclicality of the construction business is what drives sentiment around that stock. And we'll talk about that in a moment. But is there a narrative that right now is driving this stock one direction or the other? You see here the share price obviously has traded up in line with the broader market recently, but it has underperformed. And I'll get into the reasons for that in a moment. This isn't an AI stock, right? There's not a broad sweeping secular growth story underpinning this stock. It is a boring, cash rich, cash flow machine that does not receive a lot of market attention. And the reason, if you're a dividend investor, there's a lot of this dividend investing content on the internet. You may or may not have heard about this company. The main reason why you have not is probably due not to its mid-cap market size of 40-ish billion, but more so the fact it's only been a standalone company for 4-ish years. And as such, they do not have a long dividend growth streak. But I believe that if your primary motivation for investing in the stock market is to grow dividend income, that it is worthwhile to evaluate this company yourself. So that gives me a good opportunity to say that when I analyze a stock, I am not recommending that you buy or sell a security. I'm purely more going into why it is an interesting company. I do grade all of the stocks that I assess, but again, I'm just an analyst. These are my thoughts and opinions. I urge everybody watching this video to do your own research. This company is interesting. It has strong, non-cyclical cash flows that drive the majority of its profits. It's very, very sticky, high margin, low capital intensive business, the service business. It's the installation business that's more capital intensive. And that being said, is it trading at a good valuation? Well, according to Seeking Alpha, they give this a F valuation grade. And let's just kind of take a look at some of those metrics. It's trading at a 25 backward looking, 26 forward looking price earnings ratio. That's fairly expensive. It's pretty much in line with the broader market average. It's not on a price earnings basis. It's certainly not a cheap stock. And that's further reinforced by the free cash flow yield being, on the prior 12 months, 3.28%, free cash flow yield on a forward basis, 3.57%, which is lower than the 10-year treasury rate right now. So it does not have a risk premium over the 10-year treasury. A lot of stocks today don't. So that doesn't mean it's not a good investment, but it definitely is trading in a valuation band similar to a lot of stocks today, in that it is trading at a premium. That's what I would say. In terms of the dividend yield, that's a little bit more mixed because it is trading really at more or less the highest dividend yield in history, in its short history. One thing to note is that if you would have bought this when it was spun out, or if you inherited the shares when it was spun out, your current yield on cost is 3.47%. So that does imply that dividend growth has been substantial. In fact, we see that the first dividend that was paid out, May 2020, being 20 cents, the most recent dividend being 39 cents. So the dividend is almost doubled in 4 years. Pretty good growth in terms of dividends. In fact, in the most recent raise, they raised by 16%, and dividend growth has averaged 18% over those years. You see here that in terms of the growth of the business, this is a very mature, slow growing industry. Again, the growth of this industry is more or less pegged to the growth of the construction industry. So as you might imagine, with construction struggling in most developed nations right now, revenue growth is sluggish. In fact, it was 1.25% over the last year, projected to be 2.5% in the upcoming year. And the basis of that is because they have the high margin service business, they're able to command good pricing power on that, which allows them to increase their profits in excess of their revenue growth. Let's look at their balance sheet. But you do see here that their debt has been getting paid down, and their current liabilities, while going up, large part in due to some short-term borrowings from a facility. But One positive thing I will note about this is the balance sheet, is the fact that their retained earnings, which were negative, have been inching up close to positive territory, meaning that they are making a bunch of money. And the fact that their equity is remaining somewhat flat does imply that they are returning all of their or most of their cash flow to shareholders. So that is the reason that despite we've basically seen low single digit revenue growth over the last couple years and mid single digit operating income growth, that we have seen earnings per share double in that time at a mid double digit clip. I would not say that their balance sheet is strong, but it is fair and it is improving. And I will also say that they are a slow growing compounder, is how I would describe this business, because their economic profit profile allows them to compound earnings per share in the low double digits per year, despite slow revenue growth. And I think the valuation is fair, but it is not cheap. It is on the expensive side for a company growing like it is. So I would give the valuation a fair grade. It's trading at a fair price, given what it's worth. So let's talk about the risks for this company. Two main risks that I see, and they're pretty similar to each other. It's not as bad as other companies in the market today, but it does have significant exposure to China. And the thing about that is that has really been a tailwind for the last few decades. But recently, the Chinese real estate market has really been in uh, not a good place. And if you've been paying attention to the Chinese economy at all in the last few years, I'm sure you're aware that they have a tendency to build a lot of really tall buildings and a lot of real estate. And I won't go into the reasons why they've been doing that, but I will urge you to do more research about it. And I will also say that the forward outlook in the short to intermediate term is not overwhelmingly bullish. So we see here completed towers over 200 meters over the last 23 years, from 2000 to 2023, went, I'm just eyeballing this, about 25 completed towers to over 150. So that's substantial growth. If there's a tall tower, you need an elevator. So a lot of Otis's growth, again, it's only been a standalone company for a few years. A lot of their growth has come from their exposure to the Chinese market. In fact, what's interesting is that China accounts for 60% of global elevator demand, according to RBC Capital Markets. While Otis is not the most exposed in terms of their revenue, all elevator companies with a presence there are exposed. In fact, according again to this article, Otis, the world's biggest lift maker, we know that, used to generate 20% of its sales in China, but this will fall to about 14% per year. Again, this article written in October 1st, 2024. The CEO said that. The company blamed the slowing Chinese market when it cut guidance in July following a flat first half. This is the third year in a row where the China market is down 10%, Mark said. Otis's new installations are expected to fall about a third to 425,000 this year from a peak of 650,000. She also argued that a pivot to service would leave it less exposed to China in the future. So with Chinese exposure of a company like this, not only do you have tailwinds in their revenue drivers, but you also have geopolitical tensions, between us and them. There's tariff exposure, which will impact. It could impact the demand for, depending on where the materials are sourced. It could impact demand for elevators further than they are now. However, I don't believe that tariffs are material to this company. I would have to do a much deeper dive into that, which I will not do. Just know that if you are looking at this company, that might be something that you want to evaluate. So, along the same line, in addition to this main risk, which I would describe as the exposure to the Chinese market, you also have currency risk. And just taking a look at their 2023 annual report again in that section we were looking at earlier, they say here, regionally, we're becoming a more balanced and diversified company with approximately 30, and this is just service, by the way, but we know based on what we looked at in their earnings report, 85% of their profits are service based. So based in their service segment, 35% of those units are in Asia, 15% are in the Americas. That's interesting. And roughly 50% in Europe. So here's why that's important. When you're investing in this company, what you're really investing in is the cash cow, the service segment, the pricing power, the strong margin profile of that. That is the main driver of what makes this company investable. Given that only a small amount, roughly 10 to 15% of their economic profits are in dollars, we know that they are exposed to currency risk. So currency risk is another risk. I wouldn't say big, but it's a risk here. I won't attempt to quantify the currency risk, but just to give you an idea, the Chinese yen has depreciated a lot against the dollar. This chart goes back to 2009. We see here beginning in 2014, it's from 17 to 0.14. So that's roughly, I want to say, like 18% depreciation, because we know that 50% of their service revenues are in Europe. Again, I'm just going to use the euro. There's other currencies there, but it's safe to assume, I think, the majority of those revenues are exposed to euro fluctuations. We see something similar here, that euros have been depreciating versus the dollar much more severely in that time frame, from a peak of $1.6 per euro close to parity now. So the dollar has been in a period of relative strength versus both of those currencies. There's other currencies at play here as in terms of this company, but this company is exposed to currency risk. So depending on your view of forward currency fluctuations and long-term currency fluctuations, that is something to consider. So those are our risks. The risks of Chinese exposure and the risks of currency exposure and currency risk. So what would I grade this company? A buy, a hold, or a sell? Well, I would say that it is a hold. In other words, when something is a hold, I believe that it is investable. I think it's a common sense dictates that this company is strong and will continue to generate good profits for the next few decades. However, the current price is not screaming value to me. So I would say that this is a hold. The analysts on Seeking Alpha would agree, and the quant on Seeking Alpha would agree. That being said, I do own shares of this company in my portfolio. It's a relatively small position, less than 2% of the entire portfolio. I believe in its long-term prospects, and the portfolio that it is in, I have a couple portfolios, but the portfolio that I have this in is it's an income-based portfolio. The primary goal is to generate an income that is equal to or greater than the yield on the 10-year treasury, but with the dividend growth of an equity investment. So I like the dividend profile of this stock. Do I believe that it will continue to compound its dividend at 15 to 16 to 17% per year. No, I do not believe that. At least not for the next few years. But I think low double digits, high single digits is good. That's well in excess of inflation. I do believe that its starting yield is fair at 1.5%, given the profile of this business. So I do believe that if you are an income investor, particularly focused on dividend growth, that you should have this company on your watch list, study it, analyze it, and determine for yourself if it fits into your strategy. So if you were to enter into a position, let's do some technical analysis. I've already drawn a few trend lines here. This company trades in line with the broader market. We'll look at that in a second. It's strongly correlated to the market at large. In fact, why don't we just pull some data on that? I like to jump around a lot. Let's just pull some data on that really quick. Price earnings growth ratio of 2.64. Didn't address that in my earlier analysis of the valuation, but that is on the high side, I would say. Let's just compare this to the VOO, which is an ETF approximating the S&P 500. We see that not only does VOO have superior risk-adjusted returns, but that they have a fairly strong correlation. If you've used Portfolios Lab before, you know that when you compare two stocks, anything above zero point 0.4 I would consider to be pretty strong, even though this is saying it's moderate. Obviously, a 1 is strong. I would consider a 0.58 correlation. I don't know what the beta of this stock is off the top of my head, but I would guess that it's 0.8 or something. We can look at the chart. Again, we see here this company more or less trades with the broader market. So if you're trying to outperform the market in a bear market, this stock does not appear to have traded that way before. But anyways, this drawdown here and this downtrend coincided with the broader market downturn. However, like the broader market, it has been in an uptrend since October 2022 when it bottomed at $62 a share. And right now, it's kind of in the middle of this range-bound uptrend that it's in. So the stock doesn't benefit from overwhelmingly bullish sentiment. It does benefit from being a very, very strong business. Therefore, it is conceivable to think that it will continue to trade in an uptrend as long as the broader market does. But in a bear market, it likely will not fare better than the market. It does have value characteristics, but it is trading like a blend stock right now. So, yeah, we're in the middle of an uptrend here. Again, I'm not much of a technical analysis person, but the chart looks moderately bullish here, but nothing to get excited about and nothing to be overly concerned about from a technical analysis standpoint. So this stock, it doesn't make me very excited. I've got to be honest with you. The company makes me excited. I'm excited about these underlying cash flows. I'm excited about the economics that this business has. You see here 30% gross profit margin. It's not amazing, but pretty good. I like this business a lot. The stock is okay. Again, I do own it. I do have shares of it. However, it is not at the territory where I myself would go overweight this name. But if it were to sell off handedly, I would certainly think about it. So, anyways, that has been my analysis of Otis Worldwide Corporation. Hopefully, you found this video to be interesting. I've certainly had a good time walking through it. And if this content has interested you, then please keep up with my channel. I'm regularly posting content like this, both now and into the future. So I hope to see you again. And if there are stocks, companies that you want me to look at, to pay attention to, and to analyze, then please comment them below. and I will take a look at them. So, anyways, it's been fun, and I will see you again soon. All right. Thank you.